right, welcome back for another episode of the Real Estate Huddle. We are, again, as just an intro, since this is only our second episode, we're our real estate team here in the Denver metro area. And we love talking about, this is something we're passionate about, is helping people save money as they're buying homes. And so there's tons of awesome programs out there that you can take advantage of. We know the topic this last year has been interest rates and how high they've gotten. It's all about perception because the average rate over the last 50 years is 7.6%. However, it feels really high when rates for about a decade were in the threes and twos sometimes. So we're going to talk about how you can still make it and still have a payment that you can live with in this market today. So a couple things that you should know of is there are some really cool first-time homebuyer programs out there where you can take advantage and get some free money, like some grants that the government's just willing to give you. And so a couple of them are income restricted, and we've got some great mortgage pros that we've partnered with that can give you a lot deeper dive on this stuff, particular to like different counties and that sort of a thing. But there are a couple first-time home buyer programs called CHAFA from Colorado Housing and then Denver DPA, which are two great programs. One of them gives you a 4% grant, and you could actually either go with an FHA government loan or a conventional loan product. And that serves really well because how many times have we showed houses, you guys, and the condo community won't allow FHA loans, right? Too often. Yeah. It's kind of a stopping point. And so the fact that CHAFA allows you to go conventional too makes more options available for you. And so that's a really good program. And so CHAFA is about 4% is what they give you in grant money for your down payment. So you don't have to pay that. We've seen, and then DPA is up to 5% grant that's funded by the state. So
what is DPA?
DPA is just another grant program for first-time home buyers, and it's through Denver, and so it's a
quiz.
State run.
Well,
yeah.
Just for if anybody doesn't know, that's down payment assistance, right?
Yep.
So it's if you don't have the money saved up for your down payment, they can help you with a grant for that.
Yeah.
But Denver Metro has a local program for a down payment assistance program if for some reason the other one doesn't work.
Yep. Yeah, and it's just free money. The cool thing is we've seen buyers literally close a house and bring a check for $1,000, or their earnest money check was already $3,000, and then they get a check back at closing for $2,000.
Yeah, those are the best ones when they walk away with a check.
Yeah.
And the house.
Yeah, like myth, right? You need a ton of money to buy a house. No, not true. You can buy a house with $1,000 as a first-time home buyer. And the coolest part about this market right now is there's so much opportunity to negotiate, right? And try to ask for the sellers to contribute towards your closing costs. Where a year ago, were we doing that? Actually, a year ago we might have been. How about
Time's gone by too fast since
6-7 months ago?
Yeah.
No, we were not doing that.
We've been talking for how long about it. It's not really a buyer's market. It kind of feels at times like it is a buyer's market. Mm-hmm. It's not so much because there's not so much inventory, but the leverage you have as a buyer, it's been a fun way to learn more because when you get $15,000 towards a 2-1 buy down, someone's going to talk about that.
It's much easier to help buyers in this market, just in general. But on the finance end, with concessions like 2-1 buy downs, which we'll talk about in a bit, but and then just the amazing programs that we have, whether it's FHA, down payment assistance, all the way over to like USDA loans. Like there's a lot of cool programs that I don't think a lot of people know about. So this is our opportunity and your opportunity to figure out what's best for you.
I say it a lot. I think we know a lot, but we know lenders who know a lot more.
2-1 buy down? I think we're confusing the heck out of people. What is that?
Here's a 2-1 buy down. So 2-1 buy down is a chance to buy down your interest rate 2 points the first year. So instead of 7.2, it's 5.2, which saves, how many have we done? It's usually $350 a month.
I've got a calculator for it.
Yeah, it depends on the price of the home and the scenario. We could have Spencer run like an imaginary scenario.
Let's
right
run.
Now
Sounds expensive. Sounds expensive.
The second year, you're down 1%.
It's not expensive.
Well, who pays for it?
Here's the catch. Chad, tell him the catch. Who pays for
To
it?
catch it, well, not always, but usually it's the seller that's paying for it because that's the balance of the market now. I've done it the other way where they simply paid more than the asking price in exchange for that. So we got our asking price and they still get the benefit of 2 points and 1 point. It's a very valuable tool. Would you say the stat was a month ago, 60% of the transactions involved
in the Denver metro area are having a 2-1 buy down, right? So that is just huge. And just to define it, right? Buyer writes an offer with their agent, asking for the seller to contribute roughly 2.25% of the loan amount towards closing costs, right? Seller contributes a concession, is what we call it, towards their closing costs, and that allows the buyer to buy the rate down temporarily, 2% for the first year and 1% for the second year. So that is an awesome program. And the reason why is because rates are a little inflated right now due to inflation and also some other factors in the market. And so we're in a pretty good belief that, based on what economists are saying, that in a year or 2 years, rates will be different. They'll come down and they'll be lower, and you'll have an opportunity to refi to a 30-year fixed rate, which is going to be amazing, right? But in the meantime, why pay a higher rate if sellers are willing to buy that rate down for you?
So do you pay that refinance yourself?
Yeah, so that's the other awesome thing about this program. You know the answer, Jackson. He was like smirking when he asked the question. All right, so what happens there?
Just say it, Jackson.
Yeah,
So you quizzed me earlier. I'm quizzing you now.
That money that you're getting essentially for you for free from the seller stays in an escrow account, and whatever is left over at the time that you go to refinance, you can put the seller's money towards your own refinance.
It's true cash.
Yeah.
So can you refinance before, let's say you only have it for 1 year, could you refinance after 1 year?
Yeah, it'd be a great time.
Absolutely.
So let's say like the seller contributed $15,000 for you to buy the rate down for 2 years, right? And you use 1 year of that, then chances are you still have like, $5,000 to $7,000 or $8,000 left in that account. Mm-hmm. That will just be reduced from your principal balance when you go to refinance the loan the next year. So you don't lose that money. That money that's contributed by the seller, you're saving monthly, and then you're saving in bulk when you refi.
And so on the topic of saving, let's put this into some real numbers. So let's say average home price right now, we're probably looking at $650 maybe. So we'll put that as your new loan amount. Let's just say your new loan. Mm-hmm. So your new loan means after your down payment. So your new loan is $650, and that's what you base the concessions on, or that 2-1 buy down from the seller. And let's say what are our rates at today? I saw 6.8, 7. We're going to go on the high side. We'll do 7% on a 30-year loan, obviously. So like we mentioned, 2-1 buy down. First year is going to be a 2% decrease that first year. So you're at a 5% rate, which would make your monthly saving $835 per month.
So nothing.
Okay, hold on. So that's monthly, but you put that in to 12 months, you're at $10,000, $10,021 a year for that year saved.
Dang.
Okay, so
you could get
let's say
things at the dollar store,
and let's say the refi market hasn't hit below 5 yet. Okay, so you go to your next year, which it bumps up to 6%. You bump up another $400 maybe. So you're still saving a month, $427 about, which is a savings over the total year of $5,128.
That's huge.
So huge savings when you have a 2-1 buy down. And the great part, like we mentioned before, we are coming to a refi market. It's inevitable, right? Yeah. They will drop, and we're hoping, and they drop within the next 2 years below 5. We're not sure. We don't have a crystal ball, but this gives you the opportunity to be a little bit more comfortable, save money at no cost to you in this market. Typically, most 2-1 buy downs are required that the seller pays for it. So it's all on the seller's dime, and you save a bunch of money in the process.
And if you have an awesome realtor, they can negotiate that for you.
That's right. Yep. All Jackson's friends, all his Gen Z friends be like, sheesh.
But that's the timing we're in. The balance that we have somewhat depressed prices, which is simply lack of inventory and demand on both sides. Mm-hmm. Plus the ability to get this down. It's like a perfect storm for the buyer. All these vehicles allow you to get in with less money down, but
It's pretty awesome.
I know I'm talking a lot, but can I mention a few other programs that we have?
Well,
unless you guys have programs.
We will allow
I
it.
have one thing to add.
Kristen.
I did want to mention you are approved for the percent, which is 7% or 6 point whatever, right? So I did want to talk about that because I think that's important for people to know. So that being said, you can't afford the house because you'll be approved to afford the house. So then on top of that, this is just even more savings.
Correct. So yeah, when a lender runs the numbers, your debt to income ratio, they're running it on the full 7%. So you're not getting approved for something that you can't pay for 2 years down the road. That's a good point.
Great point, Kristen.
One point before you move on to 2-1. There actually is a 3-2-1, 3-year.
Yep.
But the requirement, we learned this on the last transaction we did, is the percentage of the concessions you get from the seller cannot exceed 3% of the total loan amount or the purchase price, one or the other.
Yep.
There are limitations that you have to fit in.
Yep.
Yeah, for sure.
Spencer, what are some of these awesome programs? I have one that I don't think you're going to know about, but I'll let you shoot first, and then I'll go.
So, as a team, we all are part of this, but we as a team, and me personally, individually, I love working with first responders, military, teachers, medical professionals, dentists, all that kind of stuff. We love working with those people that give us so much. So we have some pretty cool programs when it comes to the financing side, and we partner with some great lenders that make it so much easier for you on the closing cost side.
Totally. Shout out to Brian Jensen.
Yeah, Brian Jensen. He is a stud.
Yep.
But what these programs do is it eases that burden of the closing costs. So, and it's there's no catch for you. It's a true give back program that we're all a part of. And for example, I worked with a doctor. She's amazing. She was also a military medic. She's a really high ranking in the military, and she not only qualified for the VA, she was a doctor as well. So she could have gone either route, but she had a VA loan that she had never used before. So she used the VA loan, which is another great program if you can use that.
No money down.
No money down. And then on top of that, this program that's added to that, the Nightingale program, or Chalkboard or whatever it is, depending on who you're working with. But this one in particular, we as agents give back part of our compensation, which is $1,500 unless it's below $500,000, $1,500 towards your closing costs, and then the lender gives 1% of the new loan towards closing costs, and which almost takes, I think, all the closing costs away, almost in most cases. So
Huge savings.
Huge opportunity. Not a lot of people know about it. We love to share that information. A lot of people think it's too good to be true, but it truly is just our way of saying thank you. And so pretty awesome. We're all a part of it, and we love being a part of it. It's a good option for people.
Absolutely. And real quick, we're just going to segue from all the numbers talk, because the first episode we talked about areas and fun locations and all that. I feel like we're losing everybody that's not into the numbers. So
I try not to say any numbers.
Just a quick
on that
segue.
one.
No, you're fine. But one thing that makes our team unique, I feel like, is the fact that we have a lot of diversity in age on our team, and that's the cool thing. We're not looking at you, Chad.
Yeah.
Chad is super old,
but here's the cool thing. Like I graduated 2003 from Dakota Ridge High School here in Littleton, so I am a millennial, but on the older side of the millennials, right? We've got a few team members that are like right in the thick of the millennial range. Kim, who's not here, Kristen and Spencer are right there, and then we've got a Gen Zer on our team that's like.
If you don't want to work with an old fuddy-duddy.
Do you even know what a fuddy-duddy is?
Or just look at the hair if you want to work with someone who works.
It's a good quiz question.
So like Jackson and all his homies, they what do you guys do? Like you guys do fight nights, right? Stuff like that.
Do you guys collect Pokemon cards?
Yeah. No, not me personally. Back in the day, I collected Pokemon. But I'm into fighting, UFC. So we'll watch UFC. We like to go out. In Denver, there's a lot of great bars and not really clubs, but there's a lot of places to go, a lot of stuff going on. So yeah, I think Denver is a great place for young people to be in, and if you are moving here and looking, I definitely am happy with my clients to kind of help plug them into social stuff as well, as helping them on the home side. So
yeah, and not only does Jackson have a great radio voice, but he is like an encyclopedia of knowledge. And I would not know about the Gen Z population if I didn't have Jackson
I have
around
two
me.
in my house, but
So it's great.
Yeah, where you get all your information is I don't know how you just retain all of it.
Well, knows how to use the internet better than us older folks.
I'm a millennial. That's the
Hold
crazy
up,
part.
hold up. This is we are legit because Brock, who's not here, who's also on our team, is a Gen X.
On the bottom side of Gen X.
He's a Gen X. But
Would
then, are you Gen
top?
X?
Would you say? I'd say middle, right?
you're not the greatest generation.
You're not a boomer? I'm sorry. We need a birth certificate. No, I'm just kidding.
Boomers ended a little before me. They ended in like 64 or something.
Okay.
Yeah,
I'm Gen X.
yeah. Because my
Wait,
parents
no.
are right at the cusp of boomer Gen X.
I thought our parents were boomers.
They technically are. They're like I said, they're right on that border. My
All
dad
right.
was born 63. Mom's 64.
Okay.
Your mom.
So
was,
we'll call Chad a borderline boomer. We all need to respect our elders a little more. I'm sorry.
we do love having Chad on our team.
No, but the perspective that we get, the wisdom that we get from Chad, from like just I think his experience in corporate world for a long time. No, for real. Like your time with Angie's List, and which is then Angie's, like you spent a lot of time working on that side of things that just helps us get perspective on how systems work on our team and how it all comes together, and then understanding just that next generation, like of thinking and everything. You've been through the high interest rates before. You've been through a lot of that stuff that we haven't experienced, so much as like millennials and Gen Z. So it's really cool. I feel like with our team, we have a lot of that balance and perspective, and we're able to really help and relate to anyone, that we work with.
And we have awesome parties.
Oh,
Yeah.
We do.
And I
Killer parties.
actually have something which ties back to the generation gap sort of thing. So this is a grant program. I'll let you guys guess it. 40% of people are using this grant program, and for ages 18 to 29, that doubles. 80% of people are using it.
Wow.
Do you guys know what it is?
No.
Nobody wants to talk about it, but it's the bank of mom and dad. People are getting help from their parents, and the generational difference. So
80%.
Should have seen it
baby
coming.
boomers, over 65% of them said that they got absolutely no help from their parents.
Wow.
But like I just said, 80% of young people these days are getting help from their parents. So I know it might be an awkward conversation to bring up or to ask, but it's something that can set you ahead super, super far. So if your parents are willing to help you, and polls show that the overwhelming majority are willing to help their kids, it's a great thing. And as a parent, if you want to help your kid, your dollars are going to the maximum benefit if you're helping your kid purchase a home, opposed to, a car, depreciating asset, big party, whatever else you might want to do for your kid. So people don't want to talk about the bank of mom and dad, but it is something, especially with the younger generation, that I think is a key if you do have access to it, to get into home ownership a little bit early and benefit from that.
That's awesome. Yep. Yeah. And I think like with Jackson, with you being a 22-year-old homeowner, right?
23.
That's 20. I'm sorry. Just had a birthday.
I'm ancient.
Yeah. So with Jackson, like doing this, and now his friends seeing that like he's gone out and taken the step, and now his home's appreciated since he bought it, and like great things are happening, with paying principal down every month and tax savings and all these benefits of home ownership. The younger you start, the better you will do. And I think any generation here would agree with that, right? That there's just some amazing, benefits that you will reap over your life as a homeowner. And so just to bring it back real fast, full circle, we didn't talk about VA. So all of our veterans out there, just incredible VA program with no MI and no down payment. It's just the best.
MI is mortgage insurance.
Yes, thank you. Private mortgage insurance. PMI is also used as an abbreviation, and that is just foreclosure insurance for banks, basically.
When
So
you have
that you pay for.
less than 20% of equity in your home.
Correct. With 20% down, you don't have to pay it. But with less than 20, the bank feels like they're at risk, and so they charge you a premium. Usually, $100 to $300 and something bucks a month. month, depending on the loan type.
And if you're a first-time home buyer, we have a program that might help you avoid that mortgage insurance without having to have 20% down either.
Not mine, will.
Yeah.
Yeah, if you
Don't be
qualify.
coy.
And actually, are you talking about the 1%?
Yeah.
So that, not even first-time home buyer, anybody.
Yep.
Anybody can do it.
Yeah.
That's anybody.
Yep. So
Earnings limitations, but
yeah, but like it's a killer program because it's 1% down at a 350 loan amount or below. So condo buyers that are like, just trying to get in your first 1-bedroom, 2-bedroom place, there are a ton of options right now of 1 and 2-bedroom condos that you can buy in our market for $350 or less. I was just talking to an agent at our office today. He's got a place $325 in Lakewood in Snowbird that is sitting there, 2-bed, 2-bath. He hasn't had a showing, and it's like they're right there for the taking. You guys, like there's options that you can negotiate. You can get sellers to pay closing costs typically. There's just a lot of opportunity right now that probably won't be there in the springtime. So that's why we're mentioning all these programs to you, so that if you have had any thoughts about buying a house, like jump off the fence. Your payment's going to be a little higher right now, but with a 2-1 buy down and with the way rates are trending, you're going to like what the future looks like if you do that.
not to get into numbers, we said we stay clear of numbers, but the model that our lender did on a $350,000 home is you're saving $162 a month by not paying private mortgage insurance. That is not
Yes.
nothing.
Plus what Spencer talked about as far as the savings on the 2-1 buy down. So if you couple a 2-1 buy down with this 1% down program, I mean, it's huge. Average savings
It's
are
a no-brainer, honestly. I mean,
Our window, like we were talking last week when rates came down like 0.75%, 1%, like
Yep.
that is probably a
things could
good
change. Like
yeah.
right now, it's this perfect storm where we have depressed prices. We have all these vehicles to get concessions out of the sellers to get into.
Yeah.
Yeah, and
And
that
it won't last.
that
Right.
may be a good way to kind of end out, but we are in a market now where we are still seeing 2-1 buy downs. So
It's almost every year.
And that will go away.
I don't know, at least for me, my whole rule is, what are you waiting for? If you have an opportunity to buy a home, you can afford it at the rate you're given. What are you waiting for?
Well, my rent is $300 less.
Suck it up.
It
Okay?
is 100% interest. You're never getting
That's
that.
it.
point.
So you
Good
tell your
point.
clients, shut up and listen to me in the nicest way possible. You're making a mistake. Okay? No, I'm just kidding.
Hey, they don't know who you are yet.
But yeah, that's true. We'll save my personality for another episode. But seriously, if you have opportunity to buy a house right now, you shouldn't be waiting. If you're dragging your feet, you're losing money. That's what it comes down to. And if you can get in at a 7% rate, great, because you're going to refi, you're going to save money down the road and build equity.
Yep.
Safest investment you can make is real estate. So, and the 2-1 buy down is only going to last so long.
Yeah, I think it's
As
question.
Chad said,
Yep.
I mean, we're getting close to that. In my prediction, no crystal ball, obviously, but once we get below 6.5, I think we're going to start to see the frenzy begin.
No
What
question.
we were talking about yesterday, remember the adjustable rate mortgage, the ARM, like the naughty word
Yeah.
for the last 5 years?
Yep.
Oh yeah,
Probably not so bad right about now.
Yeah.
It'll go down, you ride it,
yeah,
and you refinance.
it's true.
ARMs have given people plenty of fright in the past, right? But like they are a different product nowadays.
Adjustable rate mortgage is an
You
ARM.
know,
Yeah.
I just had a conversation yesterday about all these people getting burned because they wrote an adjustable rate mortgage 3 years ago.
Mm-hmm.
But I'm sorry for that. But now it's probably a vehicle that's going to
It's
get
a
a
good-
lot more play than it's that.
Yeah, and the reason why is because now they're controlled. Now they've had regulation on the adjustable rate mortgages to where they're fixed for 5 years in a 5-1 ARM. So 5-1 ARM is an adjustable rate mortgage that's fixed for 5 years, and then it can only change 1% per year after that. So that's why it's a 5-1. There's 7-1 ARMs, there's 7-2 ARMs, there's all kinds of different products out there. But bottom line is ARMs actually tend to go up or down based on where the market's at. And so I've actually known people that have had an ARM and stuck with it for 30 years because they're like, yeah, no, it's a pretty good rate. It's always right around where the market is, and we don't mind traveling with it a little bit. So that's not for everybody if you have a very fixed income, but they're a better product than they used to be, and you can save.
What kind of buyer would that be good for?
Someone who is only going to live in their place for about 5 years or less. that can just see the writing on the wall that, hey, we're planning on growing
Not
our
so much
family,
long-term.
or we're planning on living here for 3 years and moving because of a job.
Springboard homes.
That's perfect. I mean, you can save a lot on interest just by going with an adjustable rate.
I think it's a mortgage for a shortage. So if you have a shortage of time, you're not going to be in the home for a while, it's good. Or if you have a shortage of certainty, you might be moving, you have, family things, job things going on. I think that's when an ARM could be a really good idea for certain people.
You better patent that right now. Mortgage for shortage. That's Jackson Sanborn, everyone. Hey, and a huge shout out to Greg Manzanares, who put that 1% program on the map for us. He's another one of our mortgage partners.
Way to
That's
go,
just
Greg.
awesome, great to work with, and so appreciate him. Thank you for listening, the second episode, and we'll catch you next time. So if you have enjoyed what you're listening to and you'd like to hear more, make sure to press that subscribe button so that you can not miss out on any more episodes that are coming up. And also check out all of our contact information is below. You can see us at the DreamSmithTeam.com to look up more information about our team and our history and all of the members of our team, and see contact information that you can reach us if you have any real estate needs.
See you next time.